You know what's strange about crypto? Almost everybody enters thinking about freedom, but a huge number of people leave feeling stressed, exhausted, and financially humbled. And honestly, most of the painful lessons people learn in crypto are completely predictable. But nobody tells beginners the truth early enough. Instead, social media feeds people this fantasy: instant wealth, easy money, 100x coins, overnight success stories, so people jump in emotionally without understanding what crypto actually does to human psychology. And by the time they figure it out, they've already panic sold, bought tops, trusted the wrong people, or lost money they emotionally couldn't afford to lose. Look, crypto can change lives financially. That's real. But there are also some brutal truths nobody talks about enough. And today, I want to break down the 5 things nobody tells you about crypto investing until it's usually too late. My name is Tito, and I spend way too much time thinking about investing psychology, financial systems, and why some people quietly build wealth while others keep repeating expensive money mistakes. If you're someone who wants to understand crypto realistically, avoid emotional investing traps, and make smarter long-term financial decisions, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because honestly, crypto is not just a financial game. It's a psychological game. And most people are completely unprepared for that part. Thing 1: crypto is way more emotional than you expect. Look, everyone thinks they'll stay calm until the crash actually happens. That's when reality hits. A beginner invests $5,000, the market drops 40%. Suddenly that portfolio becomes $3,000. And now something fascinating happens psychologically. Fear takes over logic. Behavioral finance research consistently shows people feel losses much more intensely than gains. This is called loss aversion, meaning losing money emotionally hurts harder than making money feels good. And crypto magnifies this because volatility is extreme. A stock market correction might feel uncomfortable. A crypto crash can feel existential. People stop sleeping, constantly refresh prices, panic scroll Twitter, watch doom videos all night. And this is where most beginners make their worst decisions. Because emotional investing usually creates emotional outcomes. Here's what most people don't realize: the hardest part of crypto is rarely technical. It's psychological. Thing 2: most people don't actually want volatility. Now you might be thinking, of course I can handle volatility, maybe. But let's be honest. Most people say they want high returns until they experience the emotional cost attached to those returns. Because huge upside usually comes with huge uncertainty. And uncertainty creates stress. This is why so many people buy near market tops. Not because they suddenly became smarter. Because rising prices feel emotionally safe. Humans naturally want social proof. When everyone is excited, people buy. When everyone panics, people sell. Exactly backwards financially. And this is where it gets really interesting. Many crypto millionaires simply survived emotionally longer than everyone else. Not necessarily smarter. Just calmer. Thing 3: social media distorts reality massively. Honestly, this might be one of the most dangerous parts of crypto today. Online, you constantly see insane gains, luxury lifestyles, 100x gems, influencers acting rich, fake screenshots, overnight success stories. But what you don't see are liquidations, panic selling, debt anxiety, losses, financial regret, because people rarely post failures publicly. This creates survivorship bias, meaning you mostly see winners, while invisible losers massively outnumber them. And psychologically, this tricks beginners into believing everybody is making money except me. Not true. In every crypto cycle, huge numbers of people lose money quietly. You just don't see those stories trending. Thing 4: the market care about your feelings. This lesson hurts people a lot. Because beginners often think, if I research enough, I'll control outcomes. Not completely. Crypto markets are chaotic. Sometimes, great projects fail, bad projects pump, irrational hype wins temporarily, scams outperform fundamentals short-term, and honestly, that frustrates intelligent people the most. Because markets are not fairness machines. They're emotional systems driven by narratives, liquidity, psychology, speculation, macroeconomics, crowd behavior. This is why certainty becomes dangerous. The moment somebody believes, I can't lose, they usually start taking reckless risks. And crypto punishes arrogance brutally. Now you might be thinking, okay Tito, so is crypto just gambling? Not exactly. But emotionally treating crypto like a casino usually creates casino outcomes. The people who survive long-term tend to manage risk, think probabilistically, avoid emotional decisions, stay patient, and survive multiple cycles. That's very different from blind gambling behavior. Thing 5. Most people are actually chasing hope. This is probably the hardest truth. A lot of people enter crypto not because they love technology, but because they feel financially trapped. And honestly, I understand that. People see rising living costs, expensive housing, stagnant wages, economic uncertainty, and crypto starts feeling like, maybe this is my chance. That emotional pressure changes behavior dramatically. Because when someone believes crypto is their escape plan, they often stop managing risk rationally. Now every trade feels deeply personal. And desperation creates terrible investing decisions. This is why financial stability outside crypto matters so much. Stable people usually make better long-term investment decisions. Desperate people often chase emotional outcomes. This is where it gets really interesting. The biggest crypto winners often don't look emotionally obsessed with crypto. They look calm, detached, patient. Because they understand something beginners usually learn too late: survival matters more than excitement. If you constantly overtrade, panic sell, chase hype, use leverage recklessly, gamble emotionally, eventually the market catches up to you. And honestly, most crypto blow-ups are self-inflicted psychologically. What I wish every beginner understood: if you're newer to crypto, here's what actually matters. 1. Protect your emotions seriously. Emotional control is one of the biggest investing advantages. 2. Never invest out of desperation. Hope is not a strategy. 3. Focus on learning first. Most beginners obsess over profits before understanding risk. Backwards. 4. Ignore most hype. The internet rewards excitement more than truth. 5. Think long-term. Most financial mistakes happen when people become obsessed with short-term price action. Here's what most people don't realize: crypto investing is really a mirror. It exposes fear, greed, impatience, insecurity, ego, emotional weakness, and sometimes the biggest financial breakthroughs happen after people learn emotional discipline. Not before. Conclusion: look, crypto absolutely can create incredible opportunities. But it can also emotionally destroy people who approach it recklessly. And honestly, the hardest lessons in crypto are usually not technical lessons. They're psychological ones. Learning patience, risk management, emotional discipline, long-term thinking, and humility. That's the real game. Because the people who usually survive and build wealth long-term are not necessarily the loudest people online. They're the people who stay rational while everybody else becomes emotional. If this video helped you think differently about crypto and investing psychology, hit the like button, subscribe, and let me know in the comments, what's the hardest lesson you learned about investing?